Hi, my name is Nat Koch. I am preparing this video to be linked to this post on the screen on the Warp Investor blog on how exchange trade funds work. Exchange trade funds, they allow investors to buy a basket of securities, so allow them to diversify their investment. In a fund that varies, its price varies during the day. So they are constantly, the price, the shares of an ETF, they are constantly varying during the day. The equivalent option that was available a while ago for those who wanted to diversify their investment was a mutual fund. And in mutual funds, this doesn't happen. If you purchase a mutual fund, shares of a mutual fund, at a certain point during the day, the investment in the mutual fund would occur at the end of the day. And because of that, and that's an advantage that mutual funds have over ETFs, because of that, there is no bid-ask spread. So on the screen, I'm showing you now an ETF called EWY, which tracks an index that is based on the South Korean market. So it's an iShares ETF. And as you can see, there is a bid-ask spread here. That's relatively small, but it's non-trivial. And in ETFs that have lower liquidity, the bid-ask spread is wider than this. You usually pay the ask price, and if you want to sell, you sell for the bid price. So in this particular case here, if you bought it and then wanted to sell it right away, you would lose money because of this bid-ask spread. In companies, this bid-ask spread can be larger than an ETF, particularly an ETF like this one, which is a high liquidity ETF. There are many investors buying and selling shares throughout the day. This is what adds liquidity to the ETF. With individual companies, particularly illiquid companies like small companies, micro caps, the bid-ask spread can be much wider. And this is something that is important for investors to pay attention to, because they may not realize that there is this bid-ask spread that guarantees that they're losing money right away if they decide to buy and sell, have second thoughts and decide to sell a stock right after, they're going to lose money. So ETFs have bid-ask spreads. Mutual funds don't have that. So that's an advantage with mutual funds. Typically, mutual funds are the only types of funds that are available in 401k and equivalent plans. So inside a 401k or a 403b, these retirement plans, typically you cannot buy and sell ETFs. You can only buy and sell mutual funds, and there is usually a rule that if you sell from a fund in a 401k account, you cannot buy it back. You cannot make a purchase of that fund for a period of time. It's often 1 month, which is why mutual fund 401k plans often they offer mutual funds that are comparable. So they may have two that track the S&P 500, one with a higher expense ratio, and that's typically what you have to do if you decide to sell from one, and you don't want to wait a full month. You have to buy from the equivalent fund that is available. So this is one advantage of mutual funds over ETFs. There is no bid-ask spread. The disadvantage is that in a mutual fund, if the fund managers has to sell shares to fulfill redemptions, because other holders of the fund are making redemptions. They're selling to turn into cash, to raise their cash amounts in their accounts. The mutual fund manager has to sell shares in the fund, in the underlying assets in the fund, and you, even if you're not one of the ones making a redemption, you have to pay taxes on those transactions. That does not happen with ETFs. With an ETF like this, EWY, you pay taxes on the distribution yield, depending on the frequency. So let's say if you're getting that yield paid to you monthly, you have to pay taxes on that on a regular basis. If the amount is significant, you would have to pay that as estimated taxes, not to pay a penalty when you file your taxes as an individual close to the deadline and before April the 15th. So you have to pay on the distribution yield, you have to pay taxes. But other than that, you pay taxes only when you sell your shares in the ETF, and of course if you have a capital gain. With mutual funds, you may have to pay taxes even if you don't sell, which is why mutual funds are good investment options in a tax sheltered account, which is the case with a 401k account. So that's what I prepared for this video. Thank you for watching.